Hello and welcome to the June 9th, 2023 episode of Watching the Tape. This week, I want to share with you a framework for understanding or explaining daily moves in financial markets. And for the purposes of this video, financial markets will include U.S. stocks, corporate junk bonds, commodities, U.S. government bonds, and gold. Every day, market price movements tell us a story. And sometimes that story is pretty straightforward and simple, and sometimes it's a bit more convoluted. When I check on daily price movements, I expect to see a pattern. That's sort of my base case. And so anything that deviates away from this pattern helps me to understand the storyline of the day. Okay, let's dive into some specifics. The framework goes by the terms risk on and risk off. A risk on environment is when investor sentiment is positive about the future of the economy. So investors push up the prices of riskier assets that are expected to perform well in a growing economy, like US stocks, corporate junk bonds, and commodities like oil and copper. Alternatively, a risk-off environment is when the investor mood is negative about the future of the economy. And so investors reject the riskier assets like stocks, junk bonds, and commodities, and instead seek the safety of US government bonds and gold. This is also called a flight to quality. Okay, if this is our baseline expectation for how markets will behave each day, either in a risk-on or a risk-off manner, then when market prices don't move as expected within our template, then there's usually a noteworthy driver that disrupts the normal relationship. Let's take a look at 3 examples from the past few months. I picked 3 days on which the S&P 500 stock market index moved up or down by more than 1%. Our first example is a risk-on day, and this is last Friday, June 2nd. So let's take a look at the price action in the riskier assets column. US stocks up 1.5%, that's a big move up. Junk bonds up 0.5%, oil up 2.3%, and copper up 0.4%. Now let's shift over to the safer assets column, and you would expect a pullback in those prices. 10-year Treasury up 10 basis points. Recall, that's the yield. So remember that bond prices and yields move in opposite directions. So the price of the 10-year Treasury was actually down. And gold was down 1.5%. This is in line with a risk-on day. Let's take a look at an excerpt from a Bloomberg article from that day. As stocks rose, Wall Street's fear gauge plummeted to pre-pandemic levels. Fear down, risk appetite up. This is a risk-on trading day. Here is an example of a risk-off trading day. The date was May 2nd. Let's take a look at the price action in the riskier assets first. US stocks down 1.2%. That's a bad day. Junk bonds down 0.3%, oil down 5% plus, and copper down almost 2%. So risk off, you would expect a bid in treasuries and in gold. So let's take a look at the 10-year Treasury note. Again, the yield was down substantially, 14 basis points. The note price was up, and for gold, it was up 1.7%. So let's take a look at an excerpt from a Bloomberg article from that date. Wall Street is quickly hitting the sell button as banking turmoil appears it is not going away anytime soon. Risk appetite did not stand a chance as traders focused on lingering doubts over the regional banks, rising recession odds, and growing risks that the U.S. could default on its debt next month. Folks, that is a classic risk-off day. And for this last example, we see a deviation from the pattern that we might expect. So let's take a look at the price action. US stocks were up 1.5%. That's a big update. Junk bonds were up almost 1%. Oil was up almost 2%, and copper was up a little bit, 0.1%. All right, let's go see. So far shaping up to be a risk on day. Let's see what happened in the safer assets column. Treasury prices were up. So the 10-year Treasury yield was down 8 basis points. The price was up, okay? And gold was down a little bit, down 0.6%. So this is a departure from the pattern that we've discussed. So what was the story that day? So let's take a look at an excerpt from a Bloomberg article. Let's see, tech shares extended the week's U.S. stocks rally after a key measure of inflation cooled last month, suggesting the Fed may be close to ending its rate hiking campaign. All right, the story on March 31st was that inflation was cooling, and that is good news for stocks and bonds because cooling inflation means that interest rates don't have to stay higher for longer in order to fight inflation. So let's wrap this up. If you follow financial markets closely, try thinking of the correlations among asset classes in this manner and see if that helps you understand the story that the market is trying to tell you every day. That's it for this week. Thanks for watching. We'll see you in 2 weeks.